I'm going to give you two investments and you're going to pick one. Investment A made 25% last year. Investment B, well, it's made 10%. That's all you know. Most people, they're going to pick investment A in a half a second. Of course they would. It's more than double. More money. Why would you ever take 10% when you can have 25%? Here's the problem. That half second is exactly how smart people blow up their net worth. If you're in tech, you got equity. You got RSUs, stock options, and a big position of one company's stock. Well, this video is for you because you've been trained your entire career to look at one number, which is the return. And hey, I get it. Returns feel good. It's the scorecard that you can talk about. When your stock has a great year, you tend to feel smart. You feel rich. But I'm here to tell you, return is half the story. It's the half everybody shows you. The other half, the half that decides whether you get to keep your money, nobody puts on the screen, and it's called risk. And the reason no one talks about it is risk is hard to feel. A unit of return is $1. But what's the unit of risk? Most people don't know, but by the end, you'll know exactly what a unit of risk is. And you're going to be able to put a number on it, and you're never going to look at return the same way again. Let me show you what you actually just picked. Investment A. Well, it's a gold mining operation in the Congo. One mine, one unstable government, one commodity price. Some years it's going to double, but some years it gets nationalized and goes to zero. Investment B, that boring 10%. Well, it's a broad basket of the entire market. Thousands of companies. Maybe boring, but super steady. Knowing that, do you still want that option A? Almost everybody flips the second they hear a Congo gold mine. That 25% stops looking like a reward and starts looking like a dare. Nothing about the return changed. The 25% is still going to be bigger than 10%. The only thing that changed is finally you saw the risk. And that's the whole game. The return is what you hope happens. The risk is everything else that could happen instead. The wild part is you don't need a gold mine to find that kind of risk. It might be sitting in your brokerage account right now, wearing a logo that you trust. Now let's make risk a real thing because vague fear isn't useful. So here's my definition, the one I give every single client. Risk is a probability that you don't get the outcome you wanted. That's it. Not a feeling, simply odds. And it has two parts. The first is probability. How likely is the bad outcome? And magnitude. How big is it if it happens? A coin flip for $1 is high probability, tiny magnitude. Who cares if you lose? Your whole net worth in one stock that could have. That's the corner of the map you have to respect. Both knobs matter. So how do we measure it? Well, this is where people's eyes start to glaze over and where I'm going to lose you for exactly 30 seconds, then make it click. The tool we use is standard deviation. Forget the formula for a second. Standard deviation just measures how spread out the outcomes are around an average. A tighter spread equals low risk. A wider spread equals high risk. So picture a bell curve. The average sits in the middle. One standard deviation out in either direction covers about 68% of all outcomes. 2 covers 95%, and 3 standard deviations cover about 99%. The wider that curve, the more uncertain your results. So let's do it with a real example. Here's 5 years of Amazon's daily price. The average was about $145. The standard deviation, i.e. the spread, was $31. So 99% of the time, Amazon traded somewhere between $52 and $238. Look at that range. Same company, same 5 years, from $52 to $238. And the average hides the worst part. In 2022, Amazon fell about 50%. Now imagine you loaded up when Amazon was trading near its peak, because that's when you felt the richest and most confident. The 5-year average return looks fine on paper, but your actual experience watching half of it evaporate does not feel so fine. So when you bought matters as much as what you bought. Would you be happy if you bought a house at the peak of the market and it dropped by 50%? That's the same question and same answer. So here's the number no brokerage app will show you. It is called the coefficient of variation. A very long name, a long formula, but a simple idea. How much risk are you taking for each unit of return? You take the risk, which is a standard deviation, divided by the expected return. Lower is better, which means less risk per a unit of return. Let me show you 2 real stocks. Amazon, over 5 years, about a 30% return, but a 52% standard deviation. You divide them, and it's the coefficient of variation is 1.7. Now Procter & Gamble, a more boring company, more stable, soap and toothpaste, an 8% return and an 11% standard deviation. Its coefficient of variation is 1.5. Amazon returned almost 4 times as much as P&G. But per unit of risk, the toothpaste company was a better deal. You were paid less for every unit of return you took in Amazon. That's what risk adjusted actually means. Not which one went up more, which one paid me more for the risk I took on. The pros aren't smarter than you. They just refuse to look at the top number without the bottom one. Here's why this isn't a thought experiment for you. If most of your net worth is in one company's stock, your employer, the one you believe in, you're holding Amazon, not the basket. You got a wide bell curve, which means a lot of outcomes that aren't expected. And it's worse than just your portfolio because your paycheck, your bonus, your career, and your savings are all riding on that same company. A bad year there just doesn't dent the portfolio. It can take the portfolio and the job in the same month. I learned this one the hard way. Years back, my family had a concentrated position, a 10b5-1 plan, and a junior advisor who never once asked the one question that mattered. What happens if the stock goes to zero? Well, it went from $90 to $13. We could do nothing. We were paper rich at the start and pretty much wiped out at the end. That's the first question I now ask every single client. So the takeaway, stop grading your investments by the return alone. The return is what you're hoping for. The risk, that bell curve of everything else that could happen, is what decides whether you get to keep it. And always ask, how much am I getting paid for the risk that I'm taking? If you want to know how wide your own bell curve is and how much risk is hiding in your portfolio right now, that's exactly what I do. Book a clarity call at alpineroadfinancial.com. In the next video, I'll show you that risk in your portfolio is actually 2 different things. One you can delete for pretty much free, and one you're stuck with no matter what you do. Most people can't tell which is which, and it's costing them. Hit like and subscribe, and I'll see you in the next one.